Room, I'll get started. Thank you all for joining us this morning. We have a great discussion lined up surrounding first-time fundraisers and what to expect in a COVID-19 world. So quite the timely discussion. Looking forward to getting to that piece, but before we do, we have the housekeeping orders to get through. So I'll try to move through those fairly quickly. My name is Lena Dobrier and I am the Director of Operations at Opus Connect. We are a lower middle and middle market M&A focused organization. We're membership based. We have members in fields of private equity, investment banking, lenders, independent sponsors, all with that lower middle market focus. We have chapters in Los Angeles, Chicago, and New York, where typically we'd be holding in-person monthly seminars. And in addition to that, we do our Deal Connect series all over the country. So those are meant to be more all-day conference deal sourcing events, similar to the one that many of you are attending today after this discussion. So if you're interested in learning a little bit more about us and what we do and how we can help you in your business development needs, feel free to reach out to my colleague, Jacob Zephyrin. His contact information is below there. Quick note on Q&A. Our panel will decide if they want to weave live Q&A into the discussion today. The way that you submit your questions is by pressing that little Q&A bubble at the bottom of your screen and submitting your questions there in written format. Our moderator will sift through those and we'll try to get to as many as possible if we can during the discussion. If not, we'll save time for afterwards. So definitely submit your questions there. These events would not be possible without the support of our sponsors, of course, so I definitely want to give each of them an opportunity to say a few words. I'm going to look in the audience here. Duncan, is that you? There's no last name, but let me give you a second to introduce yourself and your firm. Duncan, are you there?
I am here, yes.
Great.
You. Hi, everyone. This is Duncan Cummings with NFP. NFP is a leading insurance broker and consultant, and as a company we've grown significantly through private equity ownership, and so we know the private equity model very well and have built out a deliverable for other private equity firms around due diligence and one-off consulting work, as well as some cross-portfolio aggregation and other transactional insurance items like rep and warranty insurance. So if anyone has any questions or is interested in learning more, please let me know. But enjoy the event today, and thank you to the Opus team for organizing.
Thank you, Duncan. Appreciate it. We're going to move on now to Sterling National Bank. Sean, I see you in here. Please introduce yourself and your firm. Let's see here. Sean, are you there? There you go. Sean? Okay, technical difficulties. Sean, you can raise your hand if you want me to come back to you. Sterling National Bank, that was a sponsor of today's event as well, so I definitely wanted to give them. Oh, he's ready. I caught you off guard. Sean, go ahead and introduce yourself and your firm, please. Sean? Okay, we'll move on. 4 Degrees, Ablorde, are you in here, sir? Yes, you are. Here you go. Please introduce yourself and your firm.
Great. Hello, everyone. You have Ablorde here. I'm the co-founder and CEO of 4 Degrees, based here in Chicago. We are a kind of deal flow and M&A tracking and relationship intelligence software built for the private markets. Today we have about 100 customers across the private markets, so it includes private equity, M&A, independent sponsors, and investment banks. And we combine automation to eliminate data entry about your team's relationship network with a bunch of actionable intelligence to help you leverage that for your advantage. And so what I mean by that is automatically tracking your team's kind of interactions with outside parties, doing relationship strength detection to help you find your strongest path into businesses or to a specific capital provider, and pairing that with recurring reminders to making sure you're engaging with key deal flow and business development sources. So whether that be private equity sponsors and lenders and service providers. And so happy to be here with you. Excited to answer any questions that you have and to be a part of the session today. So thank you.
Next is Focus Search Partners, Steve Finder. I know he was unavailable to join this morning's discussion, but you'll hear from him later today. But I definitely wanted to acknowledge him as well. We'll move on to Resourcive. Is Nick in here? I don't see Nick Cressy. If anyone else from Resourcive is in the room, please raise your hand. I'm gonna, for a moment, go back to Sean and see if we can get him to speak. Sean, are you there? No, okay. Last but not least is Ice Miller. And before we introduce them, Tom is leading our discussion today as our moderator. We would be in their offices if we weren't here virtually. So I'll let Tom introduce himself in a moment. But before we begin the discussion, we have 2 audience poll questions that we'd like to ask. So as you see that prompt up on your screen, the box there, please submit your answers and we'll try to move through these 2 quickly as well. We want to know how you heard about today's event and see how our marketing efforts are going, what's working and what's not. We can share those results in about 5 seconds here. It looks like many of you heard from us and our sponsors, some of which are speakers. So thank you for your support, as well as LinkedIn, which is great. Second audience poll question that we have before we begin is we want to get a better idea of who's in the audience. This is going to be very helpful to us, but also to our panelists so they know who they're speaking to today. So please mark what best describes you there, and we'll review those momentarily, and then I'll kick it over to Tom. Don't be shy. Submit your answers. We'll give it about 5 seconds or so, and then we'll share them, review them, and get started. So good amount of independent sponsors, capital providers, 21% general partners, 18% limited partners. So a great mix in the room today. Without further ado, I'd like to introduce Tom Kesoglou. I hope I said that correctly, of Ice Miller, longtime supporter and friend of Opus Connect. So I'm going to bow out now, and Tom, please take it away.
Sure. So thanks, Lena. Yeah, we've been a longtime supporter of Opus Connect. My name's Tom Kesoglou. The picture that you see on the slide here is pre-quarantine picture. This is post-quarantine. So a lot can happen to you if you're stuck in New York for 3 months in your house. So Ice Miller, law firm with over 350 lawyers. We have a very robust private equity practice representing a number of GPs, independent sponsors, and people looking to raise funds on the fund formation side as well as on the transactional side. I'm based in Times Square, New York. Though we are closed for now, we would have these in our office, but I guess we'll make do virtually with what we can. But I'd like to start off by having our panelists introduce themselves. We have a really strong panel, and as the write-up suggests, we're going to be talking about their attraction to first-time funds, their diligence process during that, and the advantages GPs can give themselves in preparing for the diligence process. And also, what I'm sure what's on everyone's mind is COVID and how that has affected the GP's fundraising process as well as the LP's mind in making these investments. So I'd like to start with Stephan at Star Mountain, and then go to Marc, and then Ami.
Thanks, Tom. Appreciate everyone's time today, and hope everyone's doing well and staying safe. I agree with everyone here. We wish we could all be in person, but we're almost out of it, hopefully. So I'm Stephan Connelly. I'm a director at Star Mountain Capital. We are a U.S. lower middle market asset manager. We're currently managing about $1.2 billion in assets under management. And we view ourselves as a solutions provider to both small and medium-sized companies, as well as small and medium-sized fund managers focused in the US. We define our market as 3 to 20 million of EBITDA in companies, and then sub 350 million in fund size. Our two primary strategies are we do direct lending and equity investments into US lower middle market companies, generally family-run businesses, and we help to grow that company through add-on acquisitions and other accretive events to hopefully get them to a middle market company and then potentially sell their business. The second area where we focus on is where we are a secondary manager. So we will buy LP interests. We'll also be a solutions provider to a fund manager by restructuring a fund, reopening a fund. We can also commit additional capital to a fund, co-invest in deals. So we try to be as solution-oriented as possible. We're based in New York City, and we have offices in Cleveland, Atlanta, now Dallas, and Boston. So we're expanding nationally to be a comprehensive provider. And I'll turn it over to the rest of the team, but thank you all for making the time today.
All right. Hi, I'm Marc Kinderen, partner at 747 Capital. 747 Capital is largely a fund of funds based in New York. And what we focus on is the lower end of the middle market. We only invest in funds that raise capital anywhere between 50 million and 350 million. Essentially in companies, if you will, with revenues between 10 million and 100 million. And we consider that in our definition as the lower end of middle market. Just by focusing on those types of funds and those types of sizes, if you will, we end up investing in quite a few first-time funds. So this panel obviously, fits us pretty well. We evaluate about 100 GPs every single year. We only make about 5 or 6 commitments. But although we love to re-up with our successful GPs, many of them graduate, if you will, into what we consider the middle market. So they'll raise a $200 million fund, and then they'll raise a $400 million fund, and then they're out of our space. So at the end of the day, probably about half of the commitments that we make every single year are to first-time fund managers. We also make a lot of co-investing. We do a lot of co-investing. About 1/3 of our capital deployment every year is in co-investments. We make about 10 to 12 co-investments every single year. A majority of the deals that we do are with our GPs for obvious reasons, although we also do make investments with independent sponsors. We are a manager selection firm rather than a direct investment firm. So even when we make a co-investment with an independent sponsor, our focus is always on that particular GP in terms of have they worked together for a long period of time, what's their track record, what's their industry focus, matters like that, rather than the actual underlying transaction. Of course, we're going to look at the deal, the valuation, and the leverage and whatever, but our job with 6 investment professionals in New York City is a manager selection firm in the lower end of the middle market. And whether we make co-investments or if we make LP commitments, that's the same. In terms of size, you should look at us as a $10 million LP in these underlying funds. And in terms of co-investments, we'll make investments anywhere between $500,000 up to about $5 million. And that's what we do. Thank you. And thank you for being here.
Hi, everyone. Hope you can hear me well. My name is Ami Samuels. I'm a partner with Gatewood Capital Partners. I actually see Marc on the screen. Can everybody see me? Okay. Gatewood Capital Partners is a private equity firm. We focus specifically on anchoring new funds, fund managers in private equity, private credit, real estate. We are basically an anchor investor and a first close. We form a partnership with the general partner. We typically invest 20, 25 million, up to 30 million. We may increase that in the future. We are also focused on the middle market or the lower middle market. We have been together for quite some time. We spun out of a large international bank, and we've been together for about 15 years. We formed Gatewood in 2015. We're investing out of a discretionary pool of capital. So far, we've seeded 8 different groups at Gatewood. We're working on a few more deals. We're open to discussions with any managers, basically, with the exception of very early stage venture or public strategies like hedge funds, we don't currently do, but everything else, buyout funds, growth equity, special sits, distressed, infrastructure, on the equity side, various strategies in private credit and real estate. So I know that we're meeting with several of you virtually today. And anyone out there that we don't meet with, if you're interested in having a discussion with us, would be very happy. I want to thank Lena, Lou, Terrence from Opus Connect. It's always a pleasure. This is the first virtual event that we are participating in with you, but I participated in many of the Opus Connect events over the last few years. And so with this, I'll turn it back to Tom.
Great, thanks, Ami. So why don't we get started with the first question, which I think is probably the most relevant in terms of what's going on in today's world. So the first question is, how has COVID-19 changed your approach to investing in new funds? And so I offer that up to each of you. If you could tell me, what has changed as a result of this? Obviously, this virtualness, but certainly underwriting and trepidation or anything like that would be great if you could sort of expound on it. So maybe we can start with Stephan.
Sure, happy to. So to answer the question directly, nothing has really changed overall for us. We have a large pool of discretionary capital, and we view ourselves as a solutions provider. And so even in an environment like this, we are called a little bit more nimble than your traditional institution, either for a direct loan to a small, medium-sized family-run company or to a fund manager. The interesting thing that we've noted is the lower end of the middle market, and I think this is kind of why we're all sitting here and why our businesses exist, is that the lower middle market represents a tremendous opportunity overall. You generally find better valuations, you find better investment strategies, and it tends to potentially outperform larger funds. So there's a better return value in our part of the market. It's just challenging for big institutions to access it. This environment represents a brand new challenge for that. So in terms of what we're doing, we're quite active in financing new companies. We're also working with independent sponsors that are looking to raise a dedicated fund. And we view this as an opportunity to help them along that path, getting a couple deals done and being active and getting some momentum. And then on the secondary side, we're trying to be as creative as possible with managers, where we may take out a legacy LP to then staple a new commitment into their new fund. So nothing's really changed about our business. We are open to working virtually. So that's not been a challenge for us. But it's been interesting to see more on how fund managers react in this kind of environment. And you truly get a better understanding of people's different perspectives and their work ethic in a challenging environment like this. So it's been a very nice positive to really get to know people better and who you really want to be in business with for a very long time.
So from, I would echo all of that. Yes. So I would echo, most of that, although we don't do any direct lending or anything like that, but it is business as usual. We're hopefully going to make 2 new commitments in the month of June. And the month of June is on its way out. So we're definitely actively allocating capital to managers. But things have changed. Let's start with the process. I have to say I'm positively surprised by how efficient the beginning process of due diligence has become. Historically, for the last 20 years, we would never do a Zoom meeting for an initial meeting with a GP raising, $100 or $200 million. I mean, they'd have to show up in our office and spend an hour to an hour and a half meeting with us before we would even consider taking a next step. Today, our entire team can join in which historically was also more difficult, right? Because we were all busy doing our things, or I was in Europe raising money or doing whatever, right? Today, when we have an initial meeting, the majority of our 6-person investment team can be on that Zoom. And that makes it a lot more efficient. Also, we can have the other side have more members present within an hour and a half of a presentation. Normally, you'd only have 1 or 2 managing partners show up. But in this new world and in this new reality with this new technology, or at least new to us in terms of using it for due diligence, we have found it to be a very efficient way to hold the first and maybe second introductory meeting with GPs. And I think that historically that wouldn't have been the case, or I know that wouldn't have been the case. So that's, you know, if you will, a very positive development, I think, that has come out of this, that is definitely different now than it was, call it 3 or 6 months ago. In terms of underwriting, what Tom asked, things have changed. And the most important part, I think, is that we have to look at legacy portfolios. You know, there's quite a few funds that had a first close, call it in Q4, did a first deal, maybe 2 deals, are now raising the remainder of their funds. But we have to really look at those 1 or 2 transactions that are already in the fund. If we had not committed to that fund, you know, early on, and we're considering it for a second close, whether or not, you know, how are these deals doing? Deals that were done, you know, pro-COVID are different, you know, in terms of pricing, leverage, probably, maybe they're impacted, maybe they're not. But so the legacy portfolio has become a significant, and whether that's in the portfolio that we're buying into, or whether that's the portfolio that they had in the previous fund. Because if they're going to spend all their resources, time, and efforts in fixing problems that they had in the previous fund, maybe the fund that they're raising right now might not be that attractive to us. All of this put together actually makes a first-time fund manager more attractive to us. So to some degree, this may be beneficial to some groups, as they may not have a huge legacy portfolio, as they may not have yet done a first deal in their fund. So, and it may open up, you know, a much more affordable way of fundraising, as your initial meetings can be done via Zoom. So there are definitely some advantages, and people are allocating to funds, including ourselves. So that has not changed.
Mark, it's funny, as you mentioned on that, and sorry to jump in, but up till probably about March 8th of this year, having a pretty big portfolio when you're fundraising was a positive. And then all of a sudden, 1 week later, it was just shut off. If you have existing assets, don't even bother. So it's funny how that changed within only 1 week. We've had some LPs just said, oh, listen, you have an existing portfolio, it's not going to work. But one of the assets is a video conferencing business. They just didn't even want to bother looking at that. So it's funny how 1 week can really make all the difference.
Yeah, so I'll just add, you know, we're based in Midtown Manhattan, obviously working remotely now, but open for business, meeting via Zoom, conference calls with managers, especially now distressed managers, but also private equity and other managers. And I would say one of the challenges, which I'm sure we'll talk about on this panel, is, you know, we typically spend an enormous amount of time in our diligence and obviously the in-person meetings, getting to know the folks, getting to read their body language, their communication between the partners themselves. Obviously, we can do a lot of work and meet with people on Zoom, but it's a different dynamic. I mean, we're all cognizant of the fact that at some point this is going to open up and we're going to meet in person again. And we're having conversations with folks that we started dialogue with before the shutdown, and some that we haven't met in person with before. And so we're all hopeful, I think, that in the very near term we'll be able to meet in person, even if it's 6 feet apart. But to actually, you can't really replace an in-person meeting and that contact. And so I think things have changed, but we're all open for business.
So on that, Ami, then would you allocate to a manager without meeting them in person and having done everything virtually?
That's a very good question. That's a very good question, Tom. You know, I think that we would do a lot of work. We would do all of our diligence, but we would still probably want to meet face to face. if things are shut down for a year now and we can't meet with people, we'll probably have to reevaluate that. But this is a long-term partnership that we're going into. You know, we are partnering for the fund in which we invest. Typically, we have, you know, some kind of arrangement for another fund or up to certain AUM levels. So you're talking about a 15, 20, maybe 25-year partnership. And so you want to make sure that the key risks that you're evaluating, obviously for the strategy, the track record, all the things, but the people, key person risks and the other dynamics that are going on that are so important, you want to make sure that you get that right. So we'll have to decide whether we're going to allocate money to do a partnership without meeting in person. I find that hard to believe, but maybe.
Marc, Stephan, I'd be curious to know, just totally.
Yeah. You know, I very, proudly stated earlier, we're going to make 2 commitments in the month of June, but those were 2 groups that obviously we've been meeting with before. So the final due diligence and negotiations and everything else that happened, that happens in COVID lockdown mode. But, we had met with them, 6 months ago, some of them even longer. Or one of them even longer ago. So I would echo that I can't see ourselves making a commitment and having never met in person. Now, maybe that's also because I've been doing this for 25 years and I've never done that, right? And it is a 10, 15, 20-year partnership, and it's hard to imagine, Now, we do have tools today, whether it's this technology, but also, for quite a few years now, 6, 7, 8 years now, we do personality, I don't want to call it the test, but call it the survey, where we have an objective personality analysis of the private equity team that we may be backing or not. And that also allows us to have a view in an objective way on the personality of the individual partners and investment team members, but also on the entire team itself. And is it a well-balanced team? Is it a team that is aggressive or conservative? Is it a team that works on instinct or is highly detail-oriented? Those kinds of things we actually get out of that evaluation process that helps us to some degree and may actually allow us to make a commitment. But where I sit today, I hope we don't have to do that.
For us on the direct side, I mean, it is a little bit more of a challenge because we do want to go on, see the operations of the business, meet with a couple other management teams, and they may be in different parts of the country. So that is representing a challenge. The solutions we're coming up with is, for example, we're looking at a company in Dallas right now. Us hopping on a plane from New York going to Dallas may not be very ideal for a lot of people just concerned about safety, but we have an operating partner based in Dallas. So we're having him drive over, and I'm not saying he'll walk around with a GoPro, but it will be, at least we can check that box. We've been on site. He'll be able to see the management team in person. On the fund side, we're discussing it. I think on a secondary transaction, it presents a different kind of perspective. You're more actual assets in the ground. But for a new fund commitment, yeah, we are talking about it. And I'd actually view it as a different way. In an in-person meeting, for the perspective of LPs and GPs who are on this event, an in-person meeting in an office, to be completely frank, is fairly well scripted. A GP will come in, they'll have an understanding who's talking about what, there's an understanding of what questions will be asked. You're not really getting as much of a good perspective of who the people are and a real life scenario, because we all understand that when a fund starts, no one really projects it'll end up the way it actually started. So there's a lot of things that can happen along the way. So I actually view this virtual as actually a really good positive to get to understand and know people better. I mean, when we're speaking with LPs or GPs, they'll probably see my 2 daughters behind me doing backflips on my couch. That's an interesting way to get a better understanding of who the people are, get a really good sense of their personality, their real life. And that can be really valuable for a long-term relationship, because you're getting, people are opening up their doors to their family life and other things that you generally wouldn't have gotten in a real life scenario. So you do have to weigh the risks of not being there, checking the operations, making sure they actually have a legitimate office. But it may be better overall for your relationship and your working capability with that manager or for portfolio company long-term.
So then how are you guys doing diligence these days? I mean, you can't travel. I guess, I don't know if that's changed that much. It's really more the human interaction that's changed, but has diligence and the way you're conducting your diligence, has that changed?
Not really. You know, we're doing the same things that we would have done with the exception of in-person meetings. We're doing more calls, more, you know, Zoom meetings. And in essence, I think, you know, people are doing basically the same work. I mean, we're doing the same kind of reference calls, maybe even more. So we do an unbelievable amount of reference calling and background checks on managers, but also scrubbing the numbers on the track record. You know, there are a lot of different ways to present gross and net IRRs and EBITDA multiples and adjusted EBITDA. And we talked a little bit about this yesterday. And so I think the basic due diligence process has not changed. The thing that has changed is the kind of in-person interaction that we just discussed.
Totally agree. That you know, same thing. However, if you are looking at a track record, the tough part is to look at the unrealized track record and to be able to make sense out of it, right? I mean, like, I don't know, you know, my Q1 numbers are coming in, you know, right? It's different. And I think June 30 will be interesting as well. We are not the public markets, right? We're not going up or down with sentiment. We're going up and down with EBITDA multiples and trailing 12 months and multiples of purchase price, and then you apply them. How do you look at a track record? How do you kick the tires, you know, on an existing track record, right? That has not been realized yet. That's not an easy thing, right? Dealing and focusing on, do they have enough resources? These are small managers, right? If you're backing a first-time fund or a second fund, you know, how many people do they have? You know, 6, 8, whatever, 4. Do they have enough resources to manage that legacy portfolio? We always focused on that, of course. But today, we focus on a lot more than we did, you know, call it 6 months ago. And so our focus on due diligence has shifted with a changing time. Now, hopefully, a year from now, we'll be back to doing the normal things, including the in-person meetings. But I think that the in-person meetings and missing that, and yes, it's less of a big deal to us than really being able to figure out whether or not a manager has the right resources. And again, in the lower and the middle market, these resources are very scarce, right? Do they have enough resources to manage an existing portfolio and to deploy the capital that we're going to allocate to them? And we spend a lot more time on that today than we did 6 months ago.
Another thing to consider, I think, I agree with you, Marc. Another thing to consider is that the fundraising market has changed drastically, I think, especially for first-time and second-time fund managers. I mean, we pulled together some statistics, 2019, 269 first-time funds in the market, 2020, 595, almost a tripling. 143 second-time managers versus 256 second-time managers. And in terms of actual funds that closed, 2019, 302 first-time funds closed for 51 billion total. 234 second-time funds closed for 82 billion. But in 2020, this is as of the end of May, so just a couple of weeks ago, 37 first-time funds closed for 2.7 billion, and 21 second-time funds closed for 4.1 billion. So obviously the big question is, are institutional investors and family offices and other investors, are they going to make investment decisions in this environment? That's a major question. Are the fund managers going to be able to raise additional capital? And so that's something that we really focus on in normal times. And I think particularly now, that's going to be an area of focus.
Okay. Are there specific investment criteria or diligence topics that you require more attention to today than you did before? Or is it nothing's really changed?
I think we discussed this yesterday, and regarding the unrealized track record, we're actually it's pretty interesting the timing of when this is occurring and when you're thinking about potentially allocating to a manager. We're in June right now, and Q1 numbers are coming out for different fund managers on their unrealized performance. For all intents and purposes, January and February were actually quite good across the market overall. March was obviously not good. When you think about the weightings of importance for a valuation change, the actual EBITDA number has more weighting than the public market multiple or the comp. The public markets rebounded towards the end of March, so it wasn't actually that bad. Q2 may only filter through in, call it, July or August. So there's not really much of a pain that's been really felt yet, we believe. So you will have to further scrutinize Q1 and then wait for almost Q2. And then additional items that you have to look at is we also have the benefit of, in the lower middle market, managers generally don't have as many adjustments as the larger market. You would normally have a very heavily adjusted EBITDA in the larger market from private equity sponsors. So we don't have as much of that to sift through here. But we were talking about yesterday, some of these companies have received PPP money. You may have to look at a PPP adjusted EBITDA. You may have to look at different market comps. You may have to look at the changing customer sentiment of their underlying companies. So there's a lot of extra data that you will need to collect and sift through to really have a true understanding of where does this manager sit. So it's going to be a difficult situation. And I think that Ami's point about the slowdown in the number of managers closing capital probably leads to that. And then also potentially from some institutional investors that aren't really used to doing Zoom calls for their diligence. So there's probably a lot of capital sitting on the sidelines, and coming around September, that's probably where you'll see a lot of capital start to flow, hopefully. But in the meantime, I think it does present an interesting opportunity.
I totally agree that I think that September is going to be interesting as of September in terms of that the markets will, because it'll be more or less lost 6 months for managers to go, not to have initial meetings. You know, I'm looking forward to our meetings this afternoon, right? I mean, like, that's all great. And I think it's actually maybe even better than normal in that sense, but to really start allocating capital and closing on funds, like Ami said, I think that's, we will have a lost, call it 6 month period. But we also had that in 2008. Huh? I mean, like a lot of funds didn't get closed, you know, at the end of 2008, 2009 either. In terms of some specifics though, like where, you know, if we look at due diligence and focus, we want to be in the first close of a fund. And the reason we want to be there is because we want to be good partners. And we can be good partners if we can give them the momentum. And we want to be good partners because we want to be good partners, period. But also because we have this 10, 15-year relationships. We like to do co-investments. We have some terms that really are important to us, especially because we have a lot of foreign investors. So there's ECI issues and blocker structures and whatever. And we have certain requirements for that we'd like the attention of the GP for. And if we're in the first close, we get that attention. If we're in the final close, we may not. So, you know, we're often trying to be in the first close. But where we sit today, we are a lot more sensitive that first close will happen at a certain optimal size, right? Because, you know, we may be part of a $50 million close and we'll do 10 million out of 50 million, thinking that manager is going to raise 150 million. And 150 million might be the optimal size for that particular GP in terms of, you know, resources, in terms of kind of deals that they do, the size of the deals, the diversification, the whole 9 yards. Maybe 150 million is an optimal size. We're going to have to assume that first close is the only close. And that the model works and that they're not going to let go of half their investment staff because the fund is 1/3 of the size, right? So things where normally we would be confident and say, we're part of this first close. Maybe today we're like, well, yes, we're part of the first close. We still want to be part of the first close, but maybe we want to put the bar a little higher in terms of where that fund first close will be. And it's those kind of things that have shifted. Now there may be they may appear to be details, but I can tell you, if you're raising your first fund, which I did about 15 years ago, getting that first close on that first fund is not a little detail, right? That is like the most important part of your career, probably. So there you go. And that has changed. People are a little bit more conservative. People are a little bit more careful in joining you on the first close and doing more work. Now, again, in September, as Stephan mentioned, that may change a little bit. People may be deploying more capital. Maybe people are getting back into the market. But at this moment, to get a first close might be difficult.
Yeah, first close for first-time funds, second-time funds is typically the most difficult hurdle in their fundraising life. And assuming that they do well, it becomes easier over time. But I think what managers need to be prepared for, and it's been true for a couple of years, but even more so now, is that the fundraising period is going to be longer. People will actually extend. If they have a 12 or an 18-month fundraising period and they're in the middle of it right now, the LPs will likely give them an extension, 3, 6, maybe even 12 months to raise more capital. And, you know, hopefully we'll come back to a new normal where institutional investors are seeing the benefits of investing in first, second time funds that are, you know, historically have outperformed other funds in the market. So that push to get to a first close, I think, Marc, Stephan, is what we do, is what we help. The catalyzing event, the momentum is clearly why people will partner with us. And so and people need to be aware that it'll take longer, it'll be more difficult to raise capital, but first-time funds have been growing very rapidly. And I think that, again, assuming we come back to some kind of new normal, it's going to continue.
So there are a couple of questions that have come up, and so I want to sort of toss them out to you guys, see what you guys think. So first question is, you know, be interested in hearing your thoughts on increasing or changing your appetite for new strategies in addition to core buyout from private debt credit. So I don't know if this environment is allowing you to sort of seek different strategies or not, or nothing's changed.
We've been in dialogue with several interesting special sits and distress managers because we think that those strategies will be very interesting in the next few years. And we have actually allocations for distress and special sits, and we've been having dialogues now for, you know, the last year, but we think that now especially is an interesting time to be sort of in that area, whether it's debt for control or special turnaround, or even, you know, litigation finance, different kinds of special situations where obviously we'll see an increase in bankruptcies, right? So workouts and different managers that have expertise and are able to play in these sort of unique markets. But we're still talking to buyout funds, to growth equity funds, to even to infrastructure funds. These are, I think, longer processes, but I think especially distress and special sits are interesting right now.
So we take a view, you know, that we've been doing this for a long time, and we try to not, you know, time, if you will, in terms of whether it's special situations or whether it's growth or whether it's, you know, we find that, you know, the partners that we back are going to deploy the capital over 5 years, right? So if we select a team right now, they're going to be investing in 2021 to 2026. It's hard for us to know, it's impossible, at least to us, to have a view as to whether or not it's going to be a great time to do a particular type of transaction. So our approach is see the entire market, the entire lower end, the middle market as we define it, and select those managers that have a proven capability on a repeatable way within whatever their specialty may be to generate 3x growth. That's kind of like the benchmark that we're looking for. And to do this in a repeatable way where we can recognize it and where we can see why a deal fits a particular manager perfectly. And we are not changing that at all. Now, having said that, you know, obviously, we are influenced, right? You are in a position, and I've got a team of people, and we're all looking at this. And where I have been very hesitant in the last, call it 5 years, to look at more technology-oriented funds because of the valuation metrics and because of, primarily valuation metrics. We are considering more technology-oriented buyout funds. Now we're looking for unique kind of strategies where we can still mitigate the purchase price. We are very close to a particular GP commitment that is focused on doing corporate carve-outs of technology departments or products from larger corporations. We believe that, and then you are timing a little bit, so Ami, I'm a little bit in your side in that sense. But we believe that in the next, call it whatever foreseeable future, large companies are going to be running into trouble and they're going to have liquidity issues. Of course they are, right? And therefore, they may shed non-strategic assets, as they always have. And if you're a corporate carve-out focused fund and you're doing some technology, this may be a very good time to go into that kind of a space. So we're trying not to time it, and we're trying not to, if you will, pick particular strategies like distressed or whatever it may be. We are all influenced, and I think just another lower end of the middle market generalist buyout fund was already not very attractive to us in the last 5 years. I think moving forward, that's clearly not very attractive. One more statement perhaps is that we often back sector specialists, whether it be healthcare or industrials, whatever. We also do have more, call it style focused groups that are more growth oriented or they're more distressed oriented. In this market, we believe knowing an industry cold is probably a good thing. And so we're probably leaning a little bit more to sector expertise than we have historically, and less generalist in that sense.
I think Marc and Ami both have great platforms, and I think they've got the right perspective that we frankly can't really time the market, but obviously there are certain strategies that tend to outperform in certain vintages. I had to flip the question actually a little bit. One thing we would have a suspicion on, and I'm sure Marc and Ami would feel the same, is managers effectively evolving with the times or being a little bit more opportunistic. For example, if there was a manager that was a real estate focused firm, obviously not ideal right now, but if they all of a sudden said, hey, we're raising a distressed debt fund, just to kind of pivot to whatever may be hot at the moment, that would be looked at with a lot of skepticism. So you want to find people that have a core competency, that have a reason to exist. Obviously, there are some tangible benefits to different strategies, and you want to evolve with the market environment to not be pitching a huge growth fund right now when there's probably not much growth in the economy. You just have to tailor your messaging appropriately. And I think we're all in agreement here that timing is difficult, but picking good managers that have a strong thesis, especially with the technology bent would be nice as well, can generate above average returns in the long run.
So given the fact that you have existing relationships with managers, are you more inclined to sort of do, to back those, maybe they're not first-time funds anymore, maybe they were a first-time fund, but, and this is one of the questions that we had, the fact that you can't travel much, are you finding yourself re-upping with existing managers more than you normally would due to the fact that you have a pre-existing relationship? And so I'd be interested.
I'll jump in. In the short run, yes, although one of the managers we're now committing to is a new manager and is a first-time fund, but we had met them before, right? So then that's maybe not a totally fair, in person, right? So that actually we met them probably 4 or 5 times before. So it's like there's a serious personal connection already in that sense, right? So in the short run, call it, through September perhaps, or whatever it may be, you may be right that we would consider re-ups a little bit more seriously than not seriously, but it's just easier in that sense. If we look at we do on average 6 commitments per year. 3 of them are re-ups and 3 of them are, first-time funds or maybe a second fund that we didn't back the first time around. I don't think that will change. I think that we really enjoy the space of the emerging managers for a reason that all of us here, are on this panel And we think there's outsized return potential to backing, first-time fund managers or second fund managers. So I don't think that we're going to change that. But yes, until we can travel again, re-ups may have an edge.
Yeah, we've done basically one re-up, but basically all other transactions have been seeding new managers, and we're talking to new managers that we haven't invested with before. So, our process is very thorough. We spend a lot of time scrubbing the track record, and I mentioned yesterday on our prep call, we have 5-6 meetings that last between an hour to 5 hours each. So we are talking to primarily new managers looking for talented, best in class at whatever they do, to pick those that we think can be great partners for us for a long period of time.
We're also looking at some re-ups as well, but we're looking at it in a different lens. So I'll kind of give 2 examples. So Ami correctly pointed out, getting that first close is incredibly important. And being there as a early investor, it's a little bit of a leap of faith in saying this manager can be successful in fundraising and get to their optimal size. It's challenging in this market environment. So what we are doing with some of our managers and prospective managers is giving them a little bit of runway. What we're saying is, let's do a separately managed account. We can create a portfolio or runway for you where you may want a $20 million kind of continuation fund. We'll do a couple deals together if you have some good assets. Some of those assets can be contributed to that new fund when it gets up and running, hopefully in September. So that's an avenue we are exploring with some managers to give them a little bit of flexibility and runway. And then the other avenue is, there are a couple managers we've been in discussion with for a long time. And for whatever reason it was, we couldn't get there on their last fund, and they may have raised a suboptimal amount of capital. In this market environment, obviously they can't go out and raise their next fund when they're fully invested. So we're considering reopening or restructuring those funds to give them a new injection of capital, new runway, and kind of more relevance in this market environment. Because I'd say a handful of issues that we often see with managers in terms of fundraising, they go after the big whales. They go after, I'm not saying CalPERS and CalSTRS obviously in the lower middle market, but they go after those big checks, and they've got a handful of conversations where they're frankly low probability. They need to play small ball. You need to pick up a couple smaller checks, build that momentum to get to the bigger investors. And some managers have not evolved to appreciate that. And so you see some managers just closing on a lot less than they really hoped for. And then the last thing is, you need to really throw the whole kitchen sink at it. You can't just view it as fundraising is what it was before and will continue on. You need to be creative about it. You need to talk to non-traditional relationships. You may need to look internationally. You may need to look at online platforms that are helping in democratizing fundraising. You may need to look at other kind of seeding platforms. And I think this actually presents an interesting opportunity for, let's say, smaller allocators. They have a lot of leverage now. They can potentially get more attractive terms that they traditionally didn't even know to ask. They may get LPAC seats. They may get anchor economics. Who knows what they may be? But I think it's presenting an interesting dynamic, and it's almost required now to evolve or go away. Managers need to evolve in order to stay relevant in this market environment.
This is great how you're working, by the way, on maybe having separate accounts or like a small, that really would be obviously significantly meaningful to a GP. We can't do that because we're not big enough, and that's not what we do. But what we would do is seriously consider and make an investment, if obviously attractive, in a more of an independent sponsor kind of a transaction, right? If we really like a team, and as I said earlier on in the introduction about 747 Capital, we're a manager selection firm. We're not a direct buyout shop. We're a manager selection firm. If we really like a particular GP and their focus and everything else, they can't get to a first close. We'd love to talk to them about, and of course, pay economics on not too high, of course, very modest, but pay economics on an independent sponsor-led transaction. and maybe talk about a warehousing or whatever it may be, or join a syndicate in that sense. And I think that looking at those kind of options might also be interesting in terms of if you're on your way to a first close, but it may take a lot longer, which I think for a lot of people, it will take a lot longer, doing a deal in between and inviting groups like ourselves to join them in that particular transaction will give you great traction to then have that first close later on, maybe 2, 3, 4 months later, and when the markets have opened up again. So that may be an interim kind of an intermediate solution, if you will, to a fundraising that may have slowed down.
Another thing that I would recommend, I know we're running short on time, you know, we found it really helpful when a manager has actionable deals to actually do immediately upon a first close. So if there's 3 or 4 deals that they have under exclusivity, they've signed an agreement, and you can actually fund them right after. You can actually diligence those deals. You can speak to the CEOs, you can speak to references, you can understand the model, and you can get to know the GP a lot better by looking at specific transactions. So we don't actually do co-investing like you do, Marc, but our investors do. And we diligence specific deals, so we'll recommend to a manager to have at least 1 or 2 deals, preferably 3 or 4, that they can actually close right after a first close. It'll give additional investors, you know, more certainty that the manager can execute, and that he has, it's not a blind pool anymore, that he has something to look at specifically when he's doing due diligence.
We have about 2 minutes, maybe one more question left. And so I'd be curious to know how your pipeline of new funds coming to market is. Everyone can sort of share in that.
I have to say it's significantly slower than normal. I think we're looking at this 2008, 2009 model. You know, since we started, 20 years ago, systematically every year we evaluated between 100 and 120 GPs. That is our market. Funds between 50 and 350 million in control investments. That's the market in our view. I mean, maybe we missed 1 or 2, but that's probably about it. In 2008/2009, we only saw maybe half of that. I think that this year is going to be probably in that range as well. That doesn't mean that you're going to have less meetings, but it means that you're meeting the same people maybe more often, or that you're seeing more re-ups. I think that the market of new funds, really actively fundraising for the year 2020 will probably be about half of what 2019 was, and 2018 and 2017 and 2005, by the way.
I think, Marc, even lower, given the number of funds that are in the market, and those that have closed, you're looking at a 5 to 10% ratio. So even if money floods back in September to December, I think we're looking at a much, much slower year. And next year, too, will be a transition year.
Sure.
But I think that good managers with differentiation and unique strategies will get, traction to a first close, and then it'll take them a year to a year and a half to raise additional capital. Hopefully that'll work. But I think this year will be a lot lower than the last few years.
Yep, I definitely agree with all that we are going to see a lot of less of new first-time managers. We're seeing more second and third-time managers that are frankly having trouble getting to that next fund. And I think that's where your first-time manager kind of thesis may play out a little bit better. But yeah, it's definitely a new environment. It's going to almost be a badge of honor. I mean, there are people who have survived recessions and whatnot. Surviving a pandemic or raising capital in a pandemic is definitely going to be a unique aspect of a manager, that they've found good LPs, they've done a good job with them. So those that are considering a first-time fund, it's going to be challenging. But if you fight through it, I think you'll definitely be held in high regard in the next 3 to 4 years when you're coming back for your next one.
Great. So I think that's all the time that we've been allotted. I appreciate everyone's views on here. I think it was a fantastic panel. Thank you so much. Sorry we couldn't do this in person, or I can shake your hand, but thank you, and thanks for everyone joining. I don't know, Lena, if you wanted to say anything further.
Yeah, absolutely. I want to thank you, Tom, for moderating, and to our panelists as well for your contributions. Thank you to our sponsors and to all of you for joining us today. If you are participating in the Deal Connect portion, now's the time to log out of here and log into the separate link that Terrence has circulated. We are doing a ton of webinars, so keep an eye out for information on those. We'll be posting this as we do our others to our YouTube channel, so look out for that as well. In the meantime, stay well, and we look forward to seeing you all soon. Thanks, guys.
Thank you.
Thank you.